So I'll just go through this real quick. All a sale leaseback is, and it's similar to the property split that he went through in the U.S. This is a thing. It's not anything I made up or anybody. This is actually done all the time. Say you got John's Auto Repair. He owns an auto repair business, and he happens to own the business and the real estate. So he owns both of them. Sometimes they'll separate them into different entities. Sometimes they're under the same one, depending on how sophisticated they are and what their accountant has recommended them to do. There's tax strategies behind putting them under two different entities. And there's a lot of locked up capital in that property, in the property there. So let's say John needs to make an investment. He wants to expand. He wants to buy a piece of equipment. He wants to travel to wherever. He needs some money, and it's locked up in this right here. He doesn't want to go and refinance it. He doesn't want to necessarily increase his loan balance on his books or anything like that. And so what he does is he can sell that property to an investor, and then the investor is going to pay John some money for his property, and then he's just going to lease the property back. His business will lease it back from the investor. Thus the term sale leaseback. Does that make sense? Y'all got it? Okay. So the investor goes and makes some money, and there's several different investment groups that love commercial property, and the reason is because my whole real estate career was primarily residential property. You got 1-year leases. If the air conditioner breaks, I got to fix it. I've got to do all the repairs to the building. I've got to do all that kind of stuff, and with commercial properties, we structure ours anyway where they are triple net leases. So all of the expenses associated with the property are on the shoulders of the tenant. So the owner doesn't have to pay anything with that property. They get a 10 to 15-year lease. Annual increases is basically all they got to do is cash the check every month. But there's got to be, of course, a good solid business that can support the lease. So you've got several commercial real estate investors, real estate investment trusts, investment groups, family offices, 1031 exchange money. There's a bunch of money out there to do these type sale leasebacks, okay? So we're thinking, okay, how can we use a sale leaseback as an acquisition strategy? So let's go back to John, and now he wants to sell his business, and he wants to sell all of it, okay? So he owns the property and the business. Well, what we'll do is we'll go in and put a purchase agreement on both. 2 separate purchase agreements, one for the property, one for the assets of the business. We do treat it as an asset sale. But then we've already, ahead of time, approached investors and said, here's a property that we've got. Would you be interested in it? And so when we make our offer, we've already got an investor that we can flip the property to simultaneously with the close of the whole thing, okay? Then our business will then rent, our newly acquired business will then just lease it back from the investor. They get their ROI and their return on that, and I've got a slide in a minute around questions around that I always get. And then so what we'll do is we'll take the business, bundle it together with our other businesses that we've bought, and with our goal at the end of selling it to a large buyer, so we're making the operational money and then the exit proceeds whenever we sell the whole thing. Does that make sense? Okay. All right, so back to the Learning Center. 1.3 million. What we'll do is we found some folks who could do the valuations for us on what we could sell the properties for. This is just a screenshot of the actual report they give us, and this is all just a bunch of numbers, so I've kind of blacked it out. It's kind of the expenses associated with selling the property. But we sent this building over to our folks and said, okay, what can we net out of selling this property to an investor? And they came up with $674,985 is what we would net after all expenses. So that's how much cash we have to deal with or work with in this $1.3 million deal. So we went back to the seller and we said, we're not going to give you 1.3, we'll give you $1 million. And we'll give you, this is the actual spreadsheet we send, this is an appendix. So we'll have an LOI that says we'll pay you $1 million for your property according to the appendix. This is the appendix. The only numbers you really need to look at are we gave them $1 million, we'll give you $675 in cash, we want you to carry $325,000. And then this is just all the terms of that loan that we're asking them to take back. Interest rate, all that kind of stuff. And we've got worksheets that calculate all this stuff that I'll send to you at the end. I've got a QR code you can scan, and you enter your information, it'll automatically email you this spreadsheet so you can use this. So here's the structure. $1 million sale price, she did accept it. We asked her to carry $325,000 in seller financing. The cash due then would be $675,000. We flipped the property for $674,985. After paying the cash we agreed to, that cost us $15. So yes, it's more than $1, but we were able to get into this for 15 bucks. Okay. Now the challenge, of course, it was initially light on cash flow, but the problem, or the thing that she wasn't taking advantage of, was only open 4 hours a day when we bought this. So there was a whole morning that the building was just dark. So what we could do is put in like a Mom's Day Out program. Legally, we could do that under the regulations of child care, that they can come 4 hours a day, no more than 2 days a week. So we built what's called a Mom's Day Out program, where that would increase the revenue. Does all that make sense? Okay. So deal number 2. So taking what we've learned from deal number 1, here's what we did on deal number 2. This was East Tennessee Learning Center. We wanted more revenue, so this one was doing $836,000. The sale price was $2.1. The profit she was making was $150,000 a year, and she was just ready to retire. She'd been doing it for 20 or 30 years, however long it was, and she was ready to move on. Had a great center, waiting list, 50 kids on a waiting list, great part of town. So we made her an offer, same thing, took the property, sent it off to our evaluators, and they said, all right, after all expenses, you're going to be able to net $1,990,100 off of this property when you flip it to an investor. And we already had investors. We'll get an LOI in place with the investors that we use and that kind of stuff. So we went to the seller and said, all right, we'll give you your full asking price of $2.1 million, but we got to thinking, if we can cash out $1,990,000, what if we kept some of that? What if we just didn't give it all to the seller, right? So we said, let's try it out. So we went to offer her $1,890,000, which happened to be exactly 90% of her asking price. So we asked her to carry a note of $210,000 to make up the difference, okay? And then those are the terms of the sale. So the structure on that, $2.1 million, we asked her to finance $210,000, giving her cash of $1,990,000. We ended up flipping the property for $1,990,000, and which left us with $100,000 when we bought it, okay? Now the challenge was securing the seller note. Now what's funny is the lady we asked to carry $375,000 couldn't get out of there fast enough, and she didn't ask for anything. We could probably skip paying it, and I don't even know if she'd call us, but but this lady was really concerned over that $210,000 because we can't secure it with the building because we've sold the building, so we can't encumber the building. So we've got to figure out what we can encumber or how we can give her some security. And so what we agreed to do was to establish an escrow account. We just said, okay, look, I'll put $50,000 in an escrow account for 12 months. If we are late on a payment or we miss a payment, you can tap into that escrow account to get your money and whatever. She was happy with that, so we already had $100,000, so we just put 50 of it in an escrow account that is returned to us, by the way, at 12 months, and as long as we've made our payments. And then we kept the other $50,000 in cash. So that's how we structured that. I do put, this is a screenshot of our bank account from my phone. There were 3 deposits that came from that closing. This was back in March of last year. $46,371, so not quite $50,000, but we had to pay some stuff. Yes, sir.
Is this happening simultaneously then?
Simultaneous close, yep. So all the money comes from the investor buying the property. That's what funds basically this whole deal. So.
And when does the building owner know that you sold the property to the investor?
Well, what we do, it's all in how you frame it. This is sales. So you got to use the right words. So we say, look, we have multiple entities that we work with. We're going to have one entity that's going to take the business, another entity that's going to take the real estate. It's just one of our holding companies that we partner with on the real estate side and lease it back. And most business owners understand that because they usually, in fact she did, they'll have the business in one name and the property in the other, and they'll lease the building back from or with the business because they get better tax benefits from doing that, and most business owners understand that. So explaining this is very easy. Good question. All right, so this is the third and final one. This is our most profitable deal. Same structure, $4.1 million. This was in Arkansas. This was 3 learning centers. She had 3 locations. She was 70 years old, never married, never had kids, somehow ended up in child care, and she was ready to retire. And so her revenue was $2.5 million a year. The profit that she was bringing home was $550,000. Same thing, send it over there. We could bring $3.8 million out of closing by flipping the property. Then we made her this offer. She wanted 4.1. We said, we'll give you $4 million. We'll give you 80% of that in cash, $3.2 million, if you'll carry the other $800,000. There's the terms of all that. So the structure on that was $4 million price tag. She carried $800,000, which means we needed to bring $3.2 to closing. We flipped the property at 3.8, which means we cashed out $600,000 on that one deal between those. Now again, the challenge on this was the size and security of the note. And this is all about being creative, building rapport. In fact, when I met with this lady, I took my wife with me because, in fact, in all childcare, these are majority owned by women. And, you know, I want to be able to frame our meeting and how we're coming across. So I'll bring my wife with me. She'll talk about her kids, our kids, and so just to help connect and help them feel a lot more comfortable. So whenever you're in front of these sellers, you know, kind of try to, best you can, get into their world a little bit. So if, you know, I didn't want to come across as the Scheitzer guy coming in here trying to rip her off, so, which is not what I'm doing. She was very happy. She was debt-free. She literally had $3.2 million in cash. Plus a nice income stream from the note. So she came out very well, and she is happy she can be. But she still wanted some security for that $800,000. That's a lot of money. So what we did is the solution was we said, okay, we'll let you file a UCC on all the furniture, fixtures, and equipment. And whenever we go through our due diligence, we get them to send us a list of all of the personal property within the buildings and then them to put a value on it. Okay, and they want that number to be pretty high. So she had done that, and she had put a total value on all the stuff. This is the desks and the chairs and the toys and printers and copiers, computers, everything in the building. And she had come up with a value of about $500,000 on her. So I used her number. I'm like, okay, well, you can file a UCC, which is just a lien on the stuff. It's kind of like the same thing as a mortgage on a house. And so if we default, you can come in and take all the stuff and sell it all or whatever. And so I asked her to go get that, and I said, okay, well, here's $500,000 right here. And I said, so we need to come up with $300,000. Well, one of the properties had 2 additional commercial lots that had road frontage, and there was an access to the learning center that went between the 2 lots. And she paid $300,000 for that. I said, all right, well, we'll carve that out. That came with the deal. We carved it out and didn't sell that part to the investor. It doesn't have any value to the investor. It's not going to produce any additional revenue. He didn't care. So he ended up, we carved that out, kept it, and we told her, well, we'll let you just put $150,000 a piece on these lots, so that way if we default, you get the lots back. If we sell the lots, you get paid. In fact, we've already sold one of them to a Dollar General. Do they have Dollar Generals out here? It's kind of like a discount store. So we've already sold one of them, and so she gets $150,000 for each of those lots that we sell. So that's our $800,000. She was comfortable with that, so it allowed us to go ahead with the deal. This was a screenshot of the deposits. There's 6 deposits here, 2 per closing, because I'm not sure why they did it that way, but that's the way they did it. A little more than 607 because there were some credits for some taxes or something like that. But I get this question a lot. Why would an investor pay you more than what you're getting from or what you're giving the seller? And because they know we're pulling cash out of this deal. But then I found out what the investors are doing. So they're buying an income stream for $100,000 in rent, right? So, and then they've got the property to secure that income stream. Makes sense, right? It's a good investment. But we're flipping all these at a 10 cap. Now, those of you that are familiar with cap rates and commercial properties, 10 cap's a high rate. That's a high rate of return, but it needs to be because they're assuming a lot of risk. I'm not a national chain. You know, I'm not a grade A tenant. I'm a little guy who's looking for my first deal, right? So there's a lot of risks, so they need a higher return. Well, so in this case of $100,000 in rent, that would value the building at $1 million, right? Simple enough. Well, come to find out, and I didn't know this in the beginning, and I don't care, I want them to make money. But what I came to find out is the market rate in these particular markets for these type buildings are closer to an 8. You know, if you get into your big box shopping centers, that's like 4 to 5 cap rates. In California, it probably gets down in the 3s, but the higher the risk, the more return you want to get. But the market rate's an 8. So what they do is they immediately put it back up for sale at an 8 cap. Which now that values the property at $1.2 million, and this is supported by the market. This isn't just some made up number. This does have to be supported by the market. So they're making a $250,000 profit in 90 days, right? So they're happy. They're very happy, and they're confident in us to be able to continue to run the businesses. And we've put teams in place and all kinds of stuff to do that. So let's just kind of sum this up. So in these 3 particular deals, This was the profit on Arkansas, the Tennessee, and then Georgia was zero. It was actually $15 that we had to spend, but over $700,000. Once we instituted the Mom's Day Out program on this other one, it got us into a much better positive cash flow situation. But you add up those cash flows, you're looking at $870,000 a year on those three. And we've done other deals, and we've basically cookie cuttered this particular thing, because what we were finding was, part of the reason too why it took us a year to close is because I was looking for businesses that didn't have real estate, because I didn't want to come up with the capital. I didn't want to go get bank loans. I didn't want to deal with any of that stuff. And so I just wanted to rent them back. But most of the sellers I was coming across wanted, most of their profit or their money was tied up in that building. So they wanted to sell the building. So I had to find a solution for that. And the property split was the perfect way to do it. But how much time do I have? Okay. All right. This isn't even the best part though. And the next part is the part, and Jeremy's done videos on this, so, but this is the part that got me the most excited about mergers and acquisitions. So if you guys are good with me sharing that, I'm going to do it. I call this maximizing multiples. The time before last when I spoke at Harbour Club, I called it manipulating multiples, and Jeremy's like, let's not use the word manipulation. So we went with maximizing. But this is the part that really got me excited about mergers and acquisitions. If you think of the game Monopoly, have you guys ever played Monopoly? I love Monopoly. Now, I haven't played since the incident of '92, whenever it was a bad family event. It was pieces, cars, and houses everywhere. It was terrible. But I'm very competitive. But if you've ever noticed, there's only two businesses on Monopoly. There's the railroads, and then there's the utilities. These are treated differently than the houses, right? So the way these are treated, if I land on Pennsylvania Railroad, or whatever that says, I can't read it. If I land on that railroad and I buy it, and then someone else lands on it, they owe me 50 bucks. If I land on another one and they land on that first one I bought, they pay me 100 bucks. The third one, if they land on the original one, they pay me 300 or 200, whatever it is. And if I own all four, they owe me $400. Even if they never even land on any of these other ones, just because I now own more, they pay me more. It makes this first one more valuable. And the difference between that and real estate, which really intrigued me, is I had 300 rental units whenever I was buying real estate. And the first house I bought, that first one I bought that made me the $4,000 in cash, wasn't any more valuable because I bought home number 268. It was still worth about the same thing. Not so with businesses. Same thing with utilities. When you roll the dice, if you own one, you get 4 times the dice roll. But if you own both, you get 10 times the dice roll. Does this make sense? Y'all got that? Biz Buy Sell, Jeremy's talked about that. This is 2017. They have a 2019 out now, but they put out a report every year, which is super cool. It's called their Insight Report. You can just Google it and pull it up. If you Google 2019 bizbuysell.com Insight Report, that'll come up. And what this does is this tracks all of the sales through all of their systems. They're the largest ones in the U.S. And what this over here is a multiple. And all this is the average multiple across an industry. Let's take, this one is auto repair. 350 of them sold in 2017 through this site. The average sale price was $350,000. The median revenue was $562,000, and the median cash flow was $129,000. So all they're doing is they're taking the cash flow times the 2.64, and that came up with $300,000 sale price. Does that make sense? So that's the multiple of profit. So I use this report a lot when I'm talking to sellers, because this is a third-party, non-biased valuator kind of thing. Of course, there's lots of other valuation type software, but I can show them across all industries, hey, here's what your stuff is selling for. Okay? So I'll use this a lot. And what determines that multiple is the risk. If I buy Joe's Auto Repair on the corner of 5th and Main, and that's the only location he owns, and he's there 60 hours a week running it, if I were to go in and buy it, that's a huge amount of risk for me as the new owner, because if like Jeremy says, you're going in and paying a guy a bunch of money, you're the best employee to leave. And it's like one of those things where if he goes under, I'm 100% out of business. If I buy this business, I'm 100% out of business. So it's very, very risky for that. But there's all this money available out there with all your equity funds and all these different piles and stashes of cash that is, I call it this bubble of money up there. And the thing about Joe's Auto Repair on the corner of 5th and Main is he's down here as part of the 93% of those small businesses in that level, and their trading or their value is at 2.64 times profits. They're never going to tap into that big bubble of money because it's just not worth these big companies looking at. So what Jeremy had talked about, which really got my attention, is how do we move this guy over to this guy? Because that would be like if Joe went out and bought 20 more, or opened up 20 more locations. Now he's got economies of scale, he's got the synergies, he's got common costs across all of them, and he's greatly reduced the risk of any one location, because now if the original one goes out of business, he's still got 19 more if he's bought 20 of them, right? So he's got a lot of scale there. He's got management, he's got teams, he's got policies, procedures, he's got an HR department, he's got all those different things going on. So now these companies will pay a lot more or a higher premium because the risk is more diversified. Okay, you guys understand that, right? Makes sense. Okay, and then of course over here is this is all more publicly traded stuff. I mean, you buy Apple, I don't know, it's probably 20 times profits now, but that's your capital markets over there. So that's kind of how that stacks up. So what really got me excited, let's say we buy a company that's doing $100,000 a year in profits. So I buy it at 2.64 times EBITDA, and which gives it a $264,000 valuation. Well, if my holding company comes in and we just buy 10 more or 9 more exactly like it, for the sake of simplicity, they're all doing $100,000 a year in profits. Well, now I have a $1 million company doing $1 million in profits, all under one umbrella, that can trade at 6 times profits at $6 million. Well, what that does over here, this guy's still doing 100 grand a year. He's not doing any more, ain't doing anything any different. Still has 100,000, but he gets advantage of that 6 times profit. So now it's worth 2.5 times more than it was when I bought it. And this is just by bundling them together. And I say just by, there's obviously some moving parts to all this, but this concept right here is what got me most excited about maximizing those multiples. That's the one thing I can really take advantage of. So if I take all this, and for whatever reason it's cut off down here at the bottom, but if I take all of these that I bought, that I've just showed you, and I go and I do the math on this, the purchase price of just the business, there's a whole nother thing I could talk about, which is how we allocate the funds at closing. If we allocate more money towards the business sale of the assets, so even though we're flipping it to an investor, we may allocate a whole lot towards the asset sale because we get bonus depreciation on all that money the first year. So in fact, you know how much taxes that we've paid on all that money we've cashed out? 0, because we're able to write off all of the money we spent on the assets of the sale because of how we allocate it. So what we do is we allocate so much towards the purchase price. $400,000 for Arkansas, $210,000 for East Tennessee. Tax-wise, we actually allocated more than that, but internally, this is how we allocated this out. And then I can't read it because it's broke, but either way, this was a total of about $935,000 is what we've spent on the businesses. Then we've got, these are our average multiples. Like this one we bought at a multiple of 0.73. This one in East Tennessee, we bought at a multiple of 1.45 times profits. This one was a multiple of 1.91 times profits. So if we just average all these out and we take our total profits times 6, here's what we're able to sell it for based off of what we bought it for. These numbers are absolutely huge. So on this one right here, $2.9 million profit based off of what we're able to sell it for, just using the higher multiples if we don't increase profits at all. So that's why we're going after profitable companies to begin with, is because we just want to kind of fast track all that, and we just didn't want to get bogged down in projects of trying to do a bunch of turnaround work. So that was ours. All right. So I just closed on a deal a month ago in Richmond, Virginia, from a Harbour Clubber who sent it over to us. And so I love doing joint ventures with Harbour Clubbers. When we first started doing joint ventures with folks, we were going through equity shares and trying to do partnership agreements and who's going to do what and who gets paid what, and we got bogged down in so much legal stuff, paperwork, trying to figure it out. We said, okay, we're going to make this real simple. So for anybody that is interested in joint ventures, that's why I'm here. I love meeting new folks and doing joint ventures. We've had some successful stuff. We do referral partners. If somebody wants to just say, look, I just want to send you deals, and we can do that, then what we do is we pay a 1% referral fee just for emailing us the information on a deal, okay? If it closes. So if we close the deal, you get a 1% finder's fee. We also have operational partners that we've done some stuff with where they want to own it 100%, but they can't get past the close, or they don't have time to put into going through the whole process of getting to closing. So we've already built all of this out with our systems and structures and departments and all that stuff that can do the due diligence, put together the agreements, the contracts, go back and forth with attorneys, all that kind of stuff. But when it's done, it's all over with. But we charge a 7% fee, and we usually try to wrap it up in something like this where it comes out of the profits or proceeds of the sale, especially if there's real estate involved. So we can do that. So if anybody's like, look, I already own a company, I'd love some help getting across the finish line, we can do that. And then we actually started our own investment fund because of all the money these investors are making. We said we need to get a piece of that. So we also have a real estate fund if somebody is ever looking to put something where they can get, our investors are getting 17, 20% return on their money, and that's if we don't sell it. That's just if we keep it, because we do use debt. We raise the capital, and so the cash on cash return is pretty good there. This right here is my email address, chris@clearcapitalpartners.com, cell phone number. I do have printed up right at that back table this exact slide. So if you guys wanted to pick that up, you can. If you scan that QR code, it'll take you to a form. You can enter your name, your email address, what industry you're in, and once you hit submit, it'll automatically email you these slides as well as I think an LOI that we use, like a template, and then also that spreadsheet that we use to create those appendix for the offers on there. So all that's in there too. Any questions?
So there was a couple of questions on the app. Wow, that works long distance. So let me just have a look. One was, can we get a copy of your presentation? Yeah, so if the QR code's not scanning from there, it is on his table back here.
Yeah,
so
I've got it back here.
And scan it back here.
Mm-hmm.
Do you take options on the property to speed up a transaction?
I guess I need more clarification on what that means.
I'm looking at some commercial deals in the UK,
Mm-hmm.
which included property,
Yeah.
but the property's encumbered. So if you go through the process of sorting out that and buying out part of the deal, it's cool. It can add 6 months to the deal.
What's it encumbered by?
They got debt on the property, so you've got to work with their lenders to buy the property off them. So
Well, in the U.S., most people have debt on their properties, and that doesn't slow anything down. It just means we have to pay off the debt at closing. So we just get a closing. I don't know how it works, if it's any different in the UK or not.
No, I don't believe so.
you could also take an option on it, so that you'll take over the responsibilities of the property and lease it back.
Oh, with the lender, you mean?
No, you'll take an option to buy it with the current owner.
Yeah.
We'll see it